and get started. Good afternoon, everyone. I'm Reena Agarwal, Vice Provost for Faculty at Georgetown University and the Director of the Georgetown Center for Financial Markets and Policy. I hope everyone is staying safe and managing the work environment at home. We at Georgetown are certainly working through the same challenges, same issues that probably your universities are. Initially, it was about the spring semester, then it became summer, and now that all of those decisions have been made, our focus is on what to do about fall. And we at Georgetown really believe in shared faculty governance. So especially on the academic side, we are working very closely with our faculty leaders, faculty in general, to make the decisions as we move forward on a whole lot of different issues. Just a little bit about the Georgetown Center for Financial Markets and Policy. The center provides thought leadership for global finance. We believe in excellence in research to impact practice and policy. Being in Washington, D.C., it gives us a very interesting perspective. It's a capital of the nation, but I also think of DC as a global capital. And as we can see right now, a lot of the financial types of decisions are also made in DC. So the center recently hosted an event with 5 former chief economists of the SEC, moderated by an former SEC commissioner, examining the functioning of financial markets in the current environment. That recording is available on our website. I do invite you to learn more about the center by visiting our website and also following our Twitter handle at GUFinPolicy. The center is also committed to helping our Georgetown community, as this group especially knows there's a lot of anxiety about what's going on with my financial portfolio, my 401 plans, my retirement plans. So next week, the center is hosting an event for our Georgetown community, our faculty, staff, alumni, students, parents, so the financial markets have been dropped. Where are they headed now? And we have a great group of panelists joining us for that. I want to thank our team, John Jacobs, our executive director, and especially for this seminar series, Professor Alberto Rossi, Associate Director of the Center, and Anna Kormas, Assistant Director of the Center. We are grateful to our partners and our sponsors. Georgetown is part of the Ripples University Blockchain Research Initiative. This initiative and the sponsorships from other partners helps us to bring this series together and present it. So today we are absolutely thrilled to have Professor Antoinette Schoar presenting. Antoinette is the Stuart Myers Horn Family Professor of Finance and Entrepreneurship at MIT Sloan School. Before I turn it over to Antoinette, just a few logistical issues. So Antoinette will present, then we'll have a Q&A. Please use your, raise your hands or use the chat feature now that we're all experts on Zoom. And Alberto Rossi will manage the questions. And I'd appreciate if everybody can keep themselves on mute while the seminar goes on. And Alberto will unmute you so that you can ask a question. Thanks so much for joining us. And with that, I'm going to hand it over to Antoinette.
Thank you, Reena. It's an absolute pleasure to be here. What I want to talk to you about today is actually a consumer financial regulation question and research agenda that I've been interested in for quite some time around credit card markets and how credit card markets use big data, machine learning to target different type of customers. So, you know, I call it consumer regulation as whack-a-mole, but what I want to show you is, you know, some work that we have been doing, especially with my colleague Hong Ru, on how this, you know, what we're seeing in this market. Let me give you a little bit of background and motivation where I'm coming from. as many of you know, financial innovation, fintech have already had very significant effects on structure and pricing of retail financial services. We now have a lot of work, by many people that shows that there has been kind of a proliferation of retail financial products, and their complexity, also their sophistication has grown over the last several decades. The big question around this trend really is that, or the tension in a way, is that on the one hand, this has had actually very positive effects and probably will keep on having positive effects in the direction of reduced cost of origination, often reduced cost to solve adverse selection problem, and also allowing people to have much more personalized and therefore probably much more convenient services. But then, on the negative side, or the more concerning side, there's also a different trend that we're seeing, which is that with all this greater personalization, but also additional complexity, we start seeing that it is possible to do differential pricing of financial services for different groups. And what I'll be concerned, different groups of customers. And what I'll be concerned about today, and I'll show you some of our ongoing research on, is that it looks that it has become easier and potentially kind of more powerful also to target people's sophistication and potentially their behavioral biases by how contracts are designed, but also how offers are structured, in which pieces of an offer are shrouded, etc. So what I will show you today is work that we have done on the credit card industry and the type of offer structures we see there. As a high-level overview, I want to already summarize or motivate these results, because what we are seeing is that there is a lot of fluidity and multidimensionality in how these products are targeted, which can create dynamic challenges for regulators. So what you'll see is I will show you first, how in general the credit card industry actually targets different consumer groups, and then also show you some recent evidence or research that we have done around the Card Act of 2009, which is a very nice laboratory to test, on the one hand, how regulators have responded to some of the targeting practices that they see or saw in the market. And then I'll show you how the industry has itself then responded to this. And that's why I'm calling this whole talk Regulation by Whack-a-Mole, because it really shows that there's kind of a very dynamic interplay between these two dimensions and also these different actors. All right, so let me kind of start by summarizing, hopefully quickly, some of the background work or the earlier work that we have done that documents how card issuers target consumers of different sophistication groups. So this is joint work with my colleague Hong Ru. We started this long ago. What we showed in this work is that card companies target consumers based on their educational profiles, their financial literacy, with different types of offers. In particular, what we see is that less educated consumers receive more backloaded terms, and these terms are also more shrouded. So I'll be more precise in a second, but backloaded terms here are fees that come due after you have already used the card. So for example, over limit fees, backloaded fees, penalty APRs, right? While especially less sophisticated customers, for example, are more likely to be targeted also with introductory, very low zero APR teaser offers, etc. And then what I will also show you is actually that financial service firms are very sensitive also to the default environment of customers. And I'll show you that issuers rely more heavily on backloaded and shrouded contracts when the credit risk of consumers is actually reduced. So when the hit to the financial service company from shrouding is, you know, in some sense less risky. All right, so just, you know, kind of to put this in context, we think that, you know, this type of work speaks to a long literature, by now, a long literature on behavioral contract theory, in particular work, say, by Gabex and Lipson, or De La Vigne, Malmendier, Heithaus and Kosagi, and Michael Grubb. These are a number of different theory papers that have pointed out that when you have either myopic or time inconsistent consumers who do not understand certain attributes of a card, what in equilibrium will happen is that issuers will lower the cost or the perceived cost of these very visible parts of a contract, but then because those are the contract features that they're all competing on, because that's what the unsophisticated customer, you know, jumps to looking at. But then they will actually increase certain costs, for example, late fees or order limit fees, that the customers either not understanding fully and is myopic to not really, you know, put into context of what that means for their cost of capital, or maybe they are too time inconsistent and believe that, oh, if I get a 0 APR now, I will pay back in 6 months when the higher APR comes due, and then, you know, often they actually might not be able to do this, right? So a lot of the work that I'll show you today supports more of, you know, this behavioral view. There's obviously always a rational view, you know, in this case, right, the rational view that might also explain very backloaded contract structures for less sophisticated consumers would be if you believe that those customers are particularly credit constrained and therefore want very backloaded terms in order to smooth their consumption profiles better. That is, you know, ex ante, very viable alternative interpretation. And that's obviously something that in finance, we think is one of the big, if you want, benefits of having credit, right? So I'm not disputing that credit cards are used this way, but what I want to show you is, at least in the credit card context that we are, you know, that we are analyzing, it looks like some fees are not used in this way, and where we can indeed in our data see it because we don't only see the contract structures or the terms of the contract, we also see how they are communicated to their customers. So in some sense you can see, say that the big, maybe we feel, value added from this work that I will be showing you now is that we can see by understanding the design of the offer structure, what card issuers are really, what are the features that they want to draw the attention of their customers to. As I said, let me say this in a different way, right? What helps us to differentiate in this work the behavior from the, if you want, you know, rational view, is that we can see the actual design of the offer letter. And because we have, you know, the offer letter itself, we will be able to show you where the card issuer is drawing the person's attention to. And the difference here in how we interpret this behavioral from the rational view is that if consumers were rational and were just trying to kind of optimally smooth their cash flows over, you know, time, we would expect that actually they are shopping for those backloaded fees, right? Which means they actually, you want them to pay attention to all the contract terms as an issuer when competing with other issuers. And then there would be no need for shrouding certain parts of the terms, especially the backloaded terms, because consumers would know that at some point they have to pay, and then they want to see what are you charging them, you know, later on when the fees come due. the behavioral view would be exactly the other way around, or I mean, it would be different in this sense, right? Because if consumers indeed don't understand the full terms of credit and are myopic, then you want to shroud certain parts, in particular those backloaded fees, and draw attention to the more front-loaded part of the offer structure. And as I will show you now in a second, we can actually see that because we see the offer structure itself. So, you know, kind of, let me explain to you how we can quote unquote see this. The data we will be using here comes from Compromedia, which is a service company that collects credit card mailers sent to US households from, basically we have data from 1999 all the way actually by now to 2019, but what I'll show you is till 2016. And we have information on the individual credit card mailers that were sent to consumers, including literally, you know, kind of PDF of the envelope that it comes in, and, you know, kind of all the pages of the offer. This allows us to then figure out, right, what were all the terms in the offer, but also how they were presented on the in the offer letter. But as importantly, we don't just see the mailers sent to by companies. What is beautiful about the Compromedia data is that the way they set up the data collection is they have every month between 4,000 to 5,000, if you want, mock clients across the US that spend the whole distribution of US consumer characteristics, so that we can see how different type of financial offers different type of clients get on a monthly basis. So for example, you can see whether, say, you know, a middle class family with 2 children living in a suburb of DC, making, say, $80,000, what type of mailers they receive relative to, say, a student of 25 years old living alone, right, with a stipend of $20,000, right? And, you know, kind of, we see basically the entire distribution of these type of characteristics and the type of mail that is targeted to these different types of households. And the other thing is that because in the US credit cards are pre-approved, those credit card solicitations, they have to include the entire structure of the offer, in particular in the Schumer box. So we will actually know all the details of the credit card offer because they have to be in the letter. You know, for example, you know, Truth in Lending Act prevents that you can, you know, omit important details of the offer or even obviously lie about them. And so why does this help us? Because by having these offer structures, we can see, we call it the hard features of the offer. So all the fees, the interest rate, the reward programs, right? But we also use optical character recognition and our own algorithms to code the visual dimensions of the offer. So for example, is a certain fee, say a late fee, an introductory APR, an annual fee, are they shown on the front page or just on the back page? Are they shown in big font or in small font? Are they shown or described in a complicated language or a very plain vanilla simple language, right? So all these dimensions we can track here. So then, you know, just to give you an idea, so this is a completely made up offer structure by us, but, you know, you've all seen these credit card mailers, right? So we literally can code whether, say, for example, the 0 APR here, right, in very big font, very clear on the front page, while, say, things like, you know, the fact that after the 0 APR expires, this credit card at least will set back to 18.99 APR, right, is in much smaller font. In fact, very often it wouldn't even be on the front page, you know, but just on the last page. And so we can track all this in the offer. All right, so let me then summarize, sorry, what are we finding when we analyze this? So what we're finding is, number one, backloaded card offers are targeted to less educated consumers. in the way they do it is that card offers show strategic placement of terms, attractive feature, much more likely on the first page, large font, bold, and in color, while for educated customers, you see exactly the opposite. So just to give you, a sense, this is just a very simple visualization of all the different, regressions we do here. But so you see, for example, right, this is by education, say from just high school to people with more than college, right? You see, for example, late fees, this is negative here, right, are much lower for people who are more educated. Over limit fees, much lower for people who are educated. We can show the same thing. I just didn't want to overload you here for penalty APRs and all the backloaded pieces of the credit card offer. So this is exactly, why we're saying backloading of the offer is more likely to be targeted at less sophisticated customers. And then you see upfront fees, like annual fee, are much more likely to actually target it to more educated people. And so the idea here, right, we want to highlight is that when people are more aware of cost of capital and the fact that you have to be charged somewhere, it seems that the offer to the more educated people is actually very clearly stating, right, and upfront stating the cost of the offer, while for the less sophisticated customers, it is backloaded. And we show this across a long dimension of, other offer fees. I will skip through these painful regressions for an online talk, right, but it's very consistent across. Now, I want to highlight two things, because so far I've just shown you that the fee structure itself is different, but we can also, as I said, show you that the design is different. So for example, right, we see whether the late fees are only shown on the first page or the last page, right? So here, education are exactly those education bins I showed you before. And what you can see is that if there are late fees or high late fees, we see that for the educated people, it's less likely to be just explained on the back page, while for the less educated people, it's more likely to just be on the back page. Same, for example, on the default APR. In fact, we even, as I was saying before, can show that the readability of the front page versus the late fee, the last page, varies with your education level. So we find that, these things, FOC, index, and the grade level at which you read, these are very standard linguistic programs that are being applied to the text of the offer. And here what we see again is that for more educated people, the front page is more complex, right? But the back page is more simple. But remember, the back page is where the important features of the credit card terms are described. And so in some sense, you could say this is almost counterintuitive, because it's saying that for the less educated people, you make it more difficult to read the back page, which is where the important features are. And we know that less educated people read at a lower level of reading, right? So this is again suggesting that there's more shrouding of important features of the card towards, less sophisticated people, while for the more educated people, actually it's made easier. And again, right, the interpretation we have is that if people are not myopic, so if they are educated, they anyway know that they have to pay, say, for their credit card, and they want to know the terms at which you are charging them. So as an offerer, you don't want to shroud it, because you might maybe annoy them and then they will not take your credit card, right? However, if people are myopic and they don't know what to look for, then the shrouding might be a more successful strategy. And that's exactly what, at least the data we found here, seems to suggest. Let me then quickly, in the interest of time, say that we also find that when credit card customers or potential customers have a positive shock to their credit risk, we actually find that these shrouding strategies are used more. And the intuition behind it is that as a financial service company, right, you benefit from shrouding, say, expensive card features to myopic customers, but you only benefit if they actually pay in the end. If you're shrouding things so much that you're confusing the customer, and then, you know, they actually cannot pay because they're really poor credit risk, then that becomes a problem to the financial service company as well. And what we find is that actually, not surprisingly, the financial service companies understand this. And so we do see that when customers become actually less risky, this shrouding techniques and the backloading is used more. And the way we do this is actually, we follow a long literature in labor economics, and actually Shu, Matza, and Melzer have used that strategy before in the mortgage market. We look at when there are positive shocks, if you want, increases in unemployment insurance in the United States, in different states of the United States. We can use this as a difference in difference setup to see whether in states that had a positive increase in their UI benefits and the generosity of the UI benefits relative to other states that, you know, did not set up their UI yet, whether we see a difference in the backloading and shrouding. And just to be quick about it, that's exactly what we do see, right? We see that there's more use of late fees, more use of introductory APR, and then again, more shrouding, right? Putting things into the last page, using different language, as I was explaining before. So, you know, in sum, as a base, right, what we're finding, or as a background to what I will show you now about the Card Act, is that it looks like companies understand that consumers with different financial sophistication might respond to different design features of the card quite differentially, and they are using it to target sophisticated consumers very differently from unsophisticated consumers. In particular, just to say this again, right, it looks like less educated consumers receive offers that have more backloaded fees, higher late fees, higher over limit fees, higher default APRs, while at the same time also being targeted more with attractive upfront features, like say a teaser low APR, intro APR at the beginning. While sophisticated households seem to get offers that are priced more upfront and rely less on shrouding, but also less on backloading. Now, in the last 5 minutes, right, I want to show you the Credit Card Act, kind of cornily, you know, called the Credit Card Accountability, Responsibility and Disclosure Act, CARD, right, in 2009 was exactly targeted to limit some of the use of this targeting to the whole population. But as I just showed you, it will in particular affect the less educated people. And what the Card Act did is it had a bunch of different provisions, but for our purposes, right, it limited, or in some sense even eliminated some of what is called these fee harvester cards, meaning cards that have very high late fees, and actually it completely eliminated over limit fees, right? And as I showed you before, those were exactly the kind of fees that are often targeted at less educated people. So, you know, what again the Act did, right, it was passed by Congress in May 2009, but interestingly, it was implemented in 2 phases. So from May 2009 to February 2010, it just, in a way, increased the transparency of how offers had to be structured. So for example, you know, you had to give people more time to send them their statements before they had to pay, so that people could not somehow be shocked into, you know, kind of a repayment cycle that they didn't understand. There were no more retroactive rate increases, etc. In a way, the bulk or the big changes that we are interested in are after February 2010 and then onwards, is when the regulatory limits on late fees and over limit fees kicked in. And again, I should say that late fees were capped at $25 and over limit fees were completely eliminated. And I show you, how the industry responded to that. But there's one loophole, and that's I want to show you how, how quickly actually card companies understood that loophole, which is actually the loophole that Congress actually left open, is that if somebody defaults on a card, sorry, I should say not defaults, falls late on a card, right, even once, the card company has the right to reset the intro APR period and move immediately to the regular APR, meaning that, even though you thought you had 12 months at 0 intro APR, if you once even pay, fall 1 day late, actually your card company has now the right to then say, your intro APR period is over and, we go now with the regular APR, right? And what I'll show you quickly now is that actually affects how the backloading of cards looks like. So what we will do is again, going to use the difference in difference strategy. And now what we will do here is we will look at the different phases of the introduction of the of the Card Act, and we differentiate between types of credit cards that previously were already abiding by the Card Act provisions, right? So some types of card offers were, two particular customer types were not affected by the Card Act, and those are now our base, right, or our control group. And then we look how relative to those type of cards, cards that actually were over the limits that the Card Act stipulates, how they responded. And the nice thing, given how granular our data is, as in every definitive, right, we can control for time fixed effects, pre-trends, but we can also importantly control for bank fixed effects. So we can see how the cards within a given bank that were not affected by the Card Act relative to those affected by the Card Act, how do they change their offer structure? And so just very quickly, what do we find is that number one, right, so you see these are we call this treatment, but these are the people with the pre-exposure in the first phase of the Card Act, and then, the following, for us, right, treatment 3, and then the long run effect is what is the most interesting. And what you see, for example, what I want to show you, right, clearly the companies abided by the law. How do we see this? Remember I told you default APR was capped, so late fees were capped, over limit fees were eliminated. And you see, right, the timeline shows you how indeed companies stopped relying on these type of either high late fees or over limit fees altogether. But in response, however, what you do see is more use of intro APR, right? So now actually almost 85% of cards have an intro APR, even an intro APR on balance transfer. But the other thing you see is that the rate mean here is actually poorly termed, sorry, it's just the APR and APR balance. You see those things, once the Card Act is fully, functional, if you want, really go up. So we see actually what starts happening is that the backloading is now less on the late fees and the over limit fees because you can't use them anymore so much, right? But it's now a play between having a lot of use of intro APR and actually then very high regular APR. Because remember what I was telling you is if somebody falls late on the intro APR, then these much higher APRs set in. And then the last thing, let me show you, is that the shrouding itself also started changing, because what we now see, right, is that, not surprisingly, like the attractive things like the fact that you have a low intro APR, right, is now really highlighted in the credit card offer. Not surprisingly, actually, the credit card companies, in a way, take credit for the fact that there is no late fee anymore, or sorry, that there are much lower late fees or no default APR anymore, even though this is regulated. But the interesting thing that you see is that the actual APR, the one that the card will reset to if you fall late, are now much more shrouded. They are much less likely to be on the front page, and they are much more likely to be shrouded on the back page. And so, kind of this is, kind of just to wrap up, right? To show you that in general, right, we've seen that the onset of big data and machine learning and all these actually sophisticated tools to use data, on the one hand, indeed has allowed the financial service industry to improve the type of offers that they can, that they offer their customers in terms of overall lower rates and often more personalized contract structures. But in this talk, at least, I also wanted to highlight that it seems actually that it creates more onus, if you want, on the regulator to understand how much the sophistication of customers affects the type of offers they see, right? Because the more the financial service or any company to that extent, right? The same is true for, say, your cell phone plans or any other type of, consumer offers, right? The more we can use data to differentiate different types of customers, the more obviously there might be room to target sophisticated versus unsophisticated customers differently. And even the card act, which had lots of, there was, kind of a lot of dimensions that of cards that might hurt less sophisticated people more, right? We show you that this still creates a dynamic game where afterwards credit card companies obviously try to figure out how to stay in the limit of the law, but still differentiate sophisticated from unsophisticated customers. And ultimately, I do want to say, right, that nothing of what I showed you here is illegal at all, right? This is all within the limit of the law. But I think what we will see going forward is that the more firms use algorithms and use data for this differentiation, the more the regulator has to be careful in how precisely we spell out what we want financial service companies to do and what not. Because ultimately, right, they themselves also live in a world where there are competitive markets. And as I showed you, when you have consumers who don't fully understand the terms of credit or even their own cost of credit, when you leave it up to competition, they will shop for the wrong thing. And that actually, right, sets an equilibrium that we all might not want. But, kind of we should therefore be more clear of what is regulatorily feasible and what not. Let me stop with this and thank you for your attention.
Thank you so much, Antoinette. Thank you for the great presentation. So for the audience, if you want to raise your hands, I have a number of questions that came in through the chat. If you want to ask the question yourself, please raise your hand and I'll give you the word. Otherwise, I'll ask the questions, I'll read them out. Okay, so the first question comes in from Louis Gagnon. I'm gonna unmute you right now. You may speak.
Thank you. Thank you very much, Alberto. Thank you, Antoinette, for a great paper. It's fascinating. Just a quick question. I wonder if there's any evidence or if you can assume any basis to assume that less sophisticated households don't read the back page in these proposals, or if they have a lower propensity to read them.
So that's a really great question. So of course, right now I don't know this because I only see the offer side, right? I don't see how they even use it. I don't even see take up. We are trying actually to do some work with data from the CFPB to see kind of how the take up itself works. One thing that we have done though is we did a experiment with real people, but basically in the lab to see how they read you know, kind of offers that are being given to them. And we did find actually that, you know, people with lower education or lower financial literacy were less likely to look at the back page and also more likely to be confused by it. I should say, you know, the reason why I almost took it for granted is because, you know, for example, David Leibson, James Choi, right? I mean, and Bridget Medrin, they have actually not necessarily credit cards, but say even for mutual funds, they have a lot of really interesting work that shows small, I mean, how difficult people find it to pass more complex offer terms, even say in mutual fund agreements and these type of things.
All right.
Yeah.
Thank you so much. This is fascinating.
Cool. Thank you very much.
Thank you so much, Louis. And the next one is, question comes from Jim Angel. Jim, I'm gonna mute you right now. You may speak.
I have a question about the mock customers that are the honeypots for these offers. Are these real people who just cooperate and say, we'll give you the, we'll give you the all our junk mail, or are they actually fake people that somehow get put into the database?
A very good question. Sorry, you know, because in the interest of time, I wasn't so detailed. So it's the former. So these are real people that are literally kind of like on the pay. I mean, they're not employed, right? But they get paid for, you know, kind of putting. They even get these pre-designed, you know, kind of envelopes to put all their weekly, financial mail into it and send it to Compromedia. So these are real people. Now, they're very careful about it because, you know, they also find people don't want to do this for years on end, right? So they actually kind of turn over customers all the time. So to make sure that people don't become, for example, you know, kind of complacent or lazy about sending it back. The other thing we found in the data, right, that's why they have about 4,000 to 5,000 people across the US, is that for every cell, they have several people. It's not just one person, I see, right? So that even if some people are more precise versus less precise in how they send stuff back, you know, kind of we are, at least on average, have a good representation of the cell. Yeah.
Thank you.
You're very welcome.
Then, so we had a question from Zhu Liu that was actually asking about the consumer's reaction. So was the take-up differential or not? But I think you kind of already addressed the issue that you don't have the take-up rate here, but you have the next project that is kind of trying to address it. I have a couple of questions myself. One question is, so I think, I don't know if you covered it in the presentation or not, but so how much of we know that this happens both across banks and within banks. So we have, but how much of the variation, where is most of the variation coming from? So we have the Capital One really kind of shrouds a lot of the offers in some cases and not others, or we have that some companies specialize in some sort of customer segments?
It's a great question. And at least to us, the answer was, different from what we had expected. So the answer is that a lot of it is even within bank. So it's not, you know, kind of, so it's not the case that, you know, you can pick one bank and say, oh, they're doing all the shrouding, but they're also only targeting the, say, less educated people. And then the other bank, you know, does all the sophisticated customers. But actually most banks nowadays, most financial, card issuers target actually almost every type of customer across the board. So while I think we as consumers often associate certain credit card companies with like high end versus low end, if you actually look at the data, nowadays they all try to actually span most customer groups. The one maybe, you know, kind of subprime credit cards, that's a little bit more kind of specialized, but say even say an Amex nowadays doesn't only have black card and, you know, really rich people, but they also kind of say, do actually, joint cards with department stores, you know, grocery stores. And so you see the full thing. One thing I should say, any kind of cards that are co-branded by companies, we kicked out of our sample here because we're not sure, right, how the back-end pricing between, say, American Airlines and a credit and a bank would look, and then it might create very different things. Yeah.
I see. Yeah, perfect. Okay. Thank you so much. I think next question comes from Francesco da Punto. Francesco, I'm muting you now. Go ahead. You may speak.
Yeah, thank you. Hi, Antoinette. This is Francesco
Hi,
from
Francesco.
College. Thank you very much. I mean, the paper is super fascinating, and also the new results on the card data are great. And just, I mean, to follow up on the last point you guys were talking about and thinking about the implications in terms of regulation. So my understanding, I mean, the way in which the results, I mean, could be interpreted so far is that indeed banks are trying to exploit the low education people with this type of policies. You know, given they cannot really do much on the higher education side, instead they happen to be more transparent there. So my understanding, both based on the type of cards probably I have myself and talking to some people in the industry, is that so even this other approach of showing a very large upfront fee with potential additional benefits. So you guys were talking about potentially travel grants or say, I mean, paid access to restaurants at the airports. This is a feature I definitely myself explored a lot. And so my sense is that banks think that they can try to even make money exploiting high education people's inability to really estimate appropriately how much of these expenses they will face going forward. So they pay the upfront higher fee for the card, but then potentially they will not consume enough in order these additional benefits to pay up for this upfront. So my sense, and I mean, if I then would need to bring the results to regulators, would sort of kind of be more of the side of saying, you know, it seems like credit cards are trying to exploit both ends and with in different ways. So including the higher education end, they cannot really screw them through covering up the APRs and the backloaded fees, but they do it some other way. So would you potentially agree with this type of I mean, in terms of like, then what would be the implication for regulators? But what would you tell regulators to do, whether they should sort of address both sides or only the low education one?
So, sorry, I'm sorry for interrupting, because my next question was exactly on this one. So my question was very related to this, and is, so do you think there is any, instead, some sort of subsidizations where like the lower income individuals may be actually subsidizing the wealthier individuals, so that the wealthier individuals are getting better actually terms, and they're benefiting more from actually having the credit cards because of all the other features, and instead you have that the lower income individuals are the ones that are the net losers? So which one is it? Is it my view or is it more Francesco's view? I
mean, so these are very interesting questions. Let me try and parse them. You know, so so Francesco first, you know, kind of I cannot. So we do see, one thing we can see is that, and I think maybe, you know, that's exactly in your intuition, that different type of income groups or education groups are actually completely differentially targeted with different even reward programs. So, you know, richer people, more educated people who travel more and so on are much more likely to get miles, right? While, say, less educated and poorer people are almost never get miles, right? And maybe they get cash back, or they get points or insurance for, you know, other things and so on, right? So that's definitely true. Now, I think Francesco raised this idea that, you know, maybe an Amex card sometimes can have a $500 upfront annual fee, and you might think, right, all the miles you get afterwards, you know, will pay for that 500. So first, number one, you know, I don't have data to see how people use their rewards, right? So you're right, people could be making those mistakes. But then, you know, kind of that's also, you know, I mean, my personal view is that if I clearly state for you, you know, what your upfront fees are and, you know, what afterwards you can use the card for, then maybe it is your responsibility if you want to figure that out, right? To me, you know, kind of you know, and that's a very soft line, of course. Where do you draw the line of saying, you know, kind of, do we really want a nanny situation, right, where everything is just, you know, handled for the customer, and where do you, you know, allow them to make those choices? You know, kind of, that's obviously you know, kind of, you either data has to guide you, or we have to see how the customer likes it. The one thing I want to say to Francesco, sorry, Alberto, before I come to you, is actually what's super interesting now, if you look, is when you look at these card aggregators or these, kind of like card.com or .org, right, that tell you which cards do better, you actually see that especially for the cards to more sophisticated consumers that have all these points, you see kind of really detailed descriptions of when do you benefit from one card and what type of usage package, or user package should take, say, kind of the one versus the other card, right? And we see actually even on those aggregator websites that the cards that potentially more targeted to less educated and maybe also more subprime population have much less even of those discussions, which might show you that at least the educated, right, and more sophisticated people, they're trying to figure it out. And maybe they don't get it right all the time, but at least they're trying more, right? I mean, and the other thing I just want to say, we find, in the older paper we had done, that if you look at the offers being sent to less educated people, they often get completely dominated offers, right? I mean, it's like you really have to believe somebody doesn't understand card features at all if you send her or him an offer that's worse on almost all dimensions than another offer that they get. But for the educated people, we don't find that, right? So when firms send you new offers, they at least are beneficial on one dimension relative to the others. They never fully dominated, which already shows you, right, that I feel that the card companies understand that it's a different game, or it's a different choice dynamic behind more educated versus less educated people. So that's why I still feel we might want to think about regulation differentially, for where we set it in for, kind of the more versus less educated part of the distribution. And therefore, Alberto, I feel that the cross-subsidization we see is really more from the, either financially less sophisticated or the more absent-minded people to the people who are really good about managing their finances, right? And because it is now so, at least in the card space, because you can target individual people very differentially, there's actually even not so much cross-subsidization, but all the rents go to the bank now, right? Because you charge the educated people more upfront because you need to break even on them. And then, kind of you rely more on these fees from the less sophisticated people, but those fees are not even cross-subsidizing the more educated people. They're directly going to the bank, right? And, and again, of course, banks have cost of capital. I'm not, kind of naive, and I do want them to break even, on their cost of capital. But those are exactly the fairness issues that I feel the regulator has to be nowadays more precise when regulating algorithms rather than regulating just, loan officers. Yeah.
Thank you so much. I think next question comes from Sébastien Métellier. Sébastien, I'm unmuting you right now. Go ahead.
So, dear Professor Schoar, thank you very much for your presentation. I would like to ask two things. First, how did you come up with the idea, and also how would you see where the trend is going with the new machine learning and the data science kind of fashion trends we see in science going, and also in regards to econometrics and fintech? Because I think your topic actually could really benefit maybe also from extension, then maybe, growing with these technologies. And I think, as a young, still student, I'm intrigued by this. So.
Sure, absolutely. No, very good question. So how did I come up with it? I mean, so, in general, I've been extremely interested in consumer finance for a long time. I co-founded an organization called Ideas 42 together with Sendil Mullainathan at Chicago and Eldar Shafir, who is a cognitive psychologist at Princeton. And Ideas 42 is exactly kind of trying to use insights from behavioral economics, psychology, and economics, of course, to solve problems in society, that interface with what we are learning in these disciplines. And so, we have done, even as part of Ideas 42, a lot of work on, how to make financial inclusion and consumer finance products, kind of more beneficial to customers, especially those customers that, you know, might be more prone to behavioral biases. And I should say, right, I mean, I'm as behavioral as the worst behavioralist, right? I mean, I'm absent-minded all the time. If you left it up to me to pick my credit card, it would be a disaster. Luckily, what I do is I look what Hong does, or, you know, kind of what people who, you know, are well put together do, right? And I imitate them. And even that, right, shows you that if you are in a statistical group that is more sophisticated, right, it's easier for you to pick a good card than if your peer group, right, is, you know, perceived to be less good at choosing, right? What our research shows, actually, if, say, somebody like, you know, educated and you know, kind of good income and so on, just randomly picks a mailer out of her mailbox, already has a better choice of having a decent credit card, say, than somebody who, you know, kind of statistically looks like being less educated or poorer, even if, you know, so they have to pay even more attention than somebody like me to find the few cards that are really good within their offer choice, right? So the other thing, you know, kind of that you asked, so, you know, this is why, you know, I've been fascinated by this topic for a long time. And I should say, right, I mean, I want to be very clear. This is not saying that the banks are either doing something illegal or that they are morally reprehensible. Actually, I want to say that because they are facing competition, right? And if they just need to profit maximize. And in a word, as our data shows, for example, or, you know, kind of these very nice theory papers by Gabeck-Slebsen, or, you know, the people I cited before, right? They tell you that it's actually very difficult for an individual card issuer to break that equilibrium if your customers don't shop for the right thing, right? And therefore, really here, regulation has to become more sophisticated. And I completely agree with you, or, you know, with the notion of your question that AI and you know, kind of machine learning tools will indeed have already become extremely you know, kind of key in all consumer finance targeting and design. So what I showed you, right, is basically for the last 30 years, there have been a kind of pretty rapid development in, say, US personal finance, from people going to banks and meeting with their loan offers to get a personal loan to this type of market of pre-approved cards. And as I said before, on average, that lowers consumer finance for all of us because it cuts out so much of, you know, kind of discretionary intervention, but it has these maybe intended or unintended side consequences that I showed you, right? And I feel, let me just say, you know, this is a long answer to your question, but I actually think there is really hope for all of us that these markets will actually become better when there's more AI. Why? Because if you think about it, in an ideal world, regulators will literally be able to see the algorithm that banks you know, set up, and those algorithms have embedded in them the trade-offs that the bank makes. And so you can regulate, right? How much do you want certain behaviors or certain type of targeting rules to be applied by banks or not? Before, when it was individuals just deciding whether, you know, this person should get this loan versus that loan, right? You can't regulate into the head of people, right? And so actually regulation will be in some sense easier. What will be harder is that as a society, we will have to be much more honest in writing down what are the trade-offs we are willing to accept, right? Think about, and I'm sorry, right? We are right now in a very hard situation with COVID-19, right? Where we're making currently huge trade-offs between intergenerational and intragenerational kind of fairness, right? That we pretending we're not making them, right? But actually, you know, kind of we might find later on that, you know, kind of we actually hurt certain groups of society dramatically without really wanting it, because in some sense we are not writing down all the trade-offs that we are making when, you know, making certain choices of how to respond to the crisis right now. And so I feel, you know, as a society, we have to learn to be able to play through these hypothetical scenarios and be willing to you know, kind of to be honest about these trade-offs. Sorry.
Thank you so much, Antoinette. We are almost over time, but we have one question from Coase John. Coase, I'll unmute you right now.
Thank you.
Hi, Coase.
Hi, Antoinette. Great talk, fantastic. I wanted to ask you two related questions. One, do you find any evidence that the unsophisticated customers are learning over time? And second question is, as a response to that, do the credit card companies kind of re-intrude or recomplexify their product, with a periodicity, like every 5 years? Because sometimes I get, cards which seem to be doing that. They just arbitrarily change the terms. So, it's kind of, they ensured it in a different way. And then, they're kind of banking on the unsophisticated, even if they learned, kind of put them at a disadvantage again. I don't know whether you see evidence of something like that. There were some theory papers which argued such a dynamics, like Bruce Carlin, Douglas Gale, and so on.
Yeah, no, it's true. I mean, this is a super interesting question. I mean, unfortunately, right now, we can't look at it for two reasons. We cannot follow an individual person over time in that data, right? Because these people are so short in the Compromedia database that we unfortunately don't see that. And also because I don't see take up, right? I can't see this. There is actually a very nice paper by Agarwal, Lepson, Gabex that a little bit shows that once people are hit with a very high late fee, they seem to learn in the sense that, they actually don't fall late for a little while. And then, only after some time, maybe they forget, kind of this. And then, there's this type of dynamic. But I think this is something, kind of we would love to kind of understand better. And it's true when you talk to, executive at credit card companies, they do say that, people get used to certain cards and then those cards are not attractive to people anymore. So you have to kind of reinvent in a way, right? What you send out. Yeah.
Thank you.
Cool. Thank you.
Thank you so much. We are over time. Let me take a moment to thank very much Antoinette for the great paper and presentation. And I'd like to remind everybody next week, we're going to have David Yermak, and the title of the seminar is going to be Cryptocurrency and Stable Coins During the COVID Panic. So hopefully we'll see you there. Thank you so much, Antoinette. It was fantastic. Thank you.
Thank you so much, Roberto. It was
have
a real
wonderful
pleasure.
day.
You too. Take